The best Forex robot is not the one that wins every trade. That robot does not exist. The smarter robot is the one designed to be wrong without being destroyed. Because in trading, the goal is not to predict every move. The goal is to stay disciplined when the market refuses to cooperate. And that is the most useful lesson everyday traders can borrow from hedge funds. Not secret information, not a magical algorithm, not guaranteed profits in rising and falling markets. A system for making decisions, controlling risk, and surviving long enough for an edge to matter. So, if you are searching for the best Forex robot, stop asking only one question: how much can it make? Ask a better one: how does it behave when it is wrong? Imagine two automated systems. Robot A shows an incredible backtest. Its equity curve climbs almost vertically. When price moves against it, the robot adds another position, then another, and another. For weeks, it may look brilliant, until one strong trend turns a hidden risk into a very visible loss. Robot B looks less exciting. It risks a small predefined amount. It accepts losing trades. It reduces exposure when conditions deteriorate, and when its rules say stop, it stops. Which one appears more impressive in an advertisement? Probably Robot A. Which one is thinking more like a professional risk manager? Robot B. That difference matters because hedge fund thinking does not begin with profit, it begins with survival. So the real challenge is not finding one perfect prediction machine. It is building a decision process that knows what it can risk, when it can participate, and when it should do nothing. For a retail trading robot, that starts with position sizing. A system should limit risk on one trade, across several trades, and over an entire day. If a larger account creates uncontrolled exposure, it is not truly scalable. Next comes loss containment. A stop loss does not guarantee safety, but a defined exit is very different from hoping price will return. Hope is not a hedge. An endlessly multiplying position size is not sophisticated risk management. It is leverage hiding behind a smooth equity curve. The next hedge fund principle is diversification. But this idea is often misunderstood. Opening the same strategy on 5 currency pairs is not necessarily diversification. If those trades respond to the same US dollar move, the account may be making one large bet in 5 different windows. Better diversification comes from different sources of risk. One strategy may follow momentum, another may trade session breakouts. The objective is to avoid depending on one market behavior forever. But there is an important limit. More strategies do not automatically create a better robot. They can also create more correlation and more ways for testing to mislead you. A simpler system with transparent rules can be far more valuable than a black box with impressive vocabulary. That brings us to artificial intelligence. AI can help classify market conditions, detect patterns, or adjust filters. But the label AI tells you almost nothing about the quality of a trading product. Neither complexity nor intelligence removes uncertainty. An algorithm can make decisions faster. It cannot make risk disappear. Automation does offer one enormous advantage: consistency. A robot does not feel fear after 3 losses. It does not double the risk because it wants to recover before dinner. It does not move a stop because a trade looks like it might come back. But automation only follows the discipline built into it. If the rules encourage overtrading, the robot will overtrade perfectly. If the strategy uses unlimited recovery positions, it will execute that danger without hesitation. If the user increases risk after every losing streak, emotion has not been removed. It has simply moved from the trading screen into the settings. So, how do you evaluate the best Forex robot for your own situation? Start with evidence, not the headline return. Look at maximum drawdown, the number of trades, and the longest losing period, not only the biggest winning month. Ask whether the results include realistic trading costs. Then study the risk mechanism. Does it use a hard stop? Can it limit daily exposure? Does it use grid or martingale logic? What happens when the market gaps? Next, check whether the strategy fits your environment. A robot tested with low spreads and fast execution may behave differently on another broker. Trading sessions and news conditions can change the outcome. Finally, ask whether you understand the failure mode. You do not need to know every line of code, but you should understand what helps the strategy, what hurts it, and what prevents a bad period from becoming fatal. This is the part most advertisements avoid. They sell the dream of a machine that always knows what comes next. Professional risk management is built on the opposite assumption. Sometimes the market will do something your model did not expect. The system must be prepared anyway. That is the smarter hedge fund approach for everyday traders. Not copying the size, secrecy, or complexity of a hedge fund, copying the discipline. Define the risk before entering. Use several independent ideas carefully. Measure correlation, control exposure. Accept small losses. And never confuse a winning streak with proof that risk has disappeared. The best Forex robot is not a money-printing machine. It is a tool for executing a tested process without panic, greed, or improvisation. It may win in rising markets. It may find opportunities in falling markets. And sometimes the smartest decision it can make is no trade at all. If you want more honest breakdowns of automated trading systems, subscribe to the channel. And in the comments, tell me which matters more to you, the highest possible return or the ability to survive the market long enough to keep trading. This video is for educational purposes only and is not financial advice. Trading involves risk, and no robot can guarantee profits.